Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump heats up his trade war with new threats to trading partners. Full coverage is ahead. Plus, can the market euphoria last? That's the question today as U.S. stocks drop after hitting record highs. We'll break down what comes next. And we dig into what to expect from big bank results as earnings season shifts into full swing. All that and more coming up on Market Catalysts. Let's get a quick check of the major indexes. We're seeing losses across the board here. Losses are being led by the Dow. We are off around 260 points there. The NASDAQ recovering a little bit from earlier lows. We're still off around 0.2%. And same with the benchmark S&P 500, off about 0.4% after we hit a record high for both the NASDAQ and the S&P 500. And in the bond market, I want to take a look at the 10-year Treasury yield. We're seeing that hover around 4.4%. If we take a look at a 5-day, we were at those levels earlier in the week. We dipped down and now we're slightly coming back to that 4.4%. So just something to keep an eye on as we continue to track updates on the Fed front and of course the U.S. deficit concerns. And just looking at a year to date, we've seen some choppiness in longer term yields, particularly the 10-year and the 30-year. But right now we're at that 4.4% level. Now to our top story of the day. To close out a whirlwind week of tariff announcements, President Trump threatened a 35% tariff on Canadian goods late Thursday. He also said in an NBC interview he plans to impose blanket tariffs on most U.S. trade partners while also dismissing any negative impact the levies could have on inflation. Here to discuss the latest is Lou Bassanese, founder of thebigskinny.com, and Washington correspondent Ben Werschel. So Ben, let's start with you here. What's the significance of Trump's threat to Canada?
Pretty significant threat, partly because of the surprise nature of it. Canada was seen as on a different timeline. It wasn't included in Liberation Day 1.0. So what we're seeing is this kind of surprise with this 35% rate on Canada. We do have some new details this morning about exactly what this 35% rate means, which may be a little bit of a bomb to markets here, which is that a White House official tells me that this is a raise from 25% to 35% on certain goods. At least it's expected to be. Other carve-outs that have been negotiated over recent months are expected to continue. I stress the word expected. The big ones there are USMCA compliant goods. That is estimated to be about 40% of goods of imports from Canada. Those would continue to see lower rates. Many of those have zero tariffs based on the 2020 agreement. Those will be up for negotiation next year. The other big one is oil and fertilizer. Potassium-based potash. These have been big flashpoints, partly because of how crucial they are to kind of the functioning of the U.S. economy. They see a 10% rate now, and again, the expectation is that rate would continue. The White House official stresses to me, nothing is final here, everything's up for negotiation with Trump, and this all leads to an August 1st deadline that we'll see back and forth on here, but the expectation right now is that those carve-outs will continue even as everything else goes to 35%.
Ben, I don't know how you do it because these back and forth trade developments, they're confusing to me. But real quickly here, what TBD trade deal do you think investors are most focused on right now, at least when it comes to getting a little bit more clarity?
Yeah, I mean, the big economic shoe we've been waiting for to drop, we've been kind of waiting all week, is outside of this is the European Union. This kind of was a week we came in expecting there might be some sort of deal there. There's been parameters floated that would be really market friendly of a 10% rate with certain carve-outs for certain industries. That would be a major deal if that goes through. We haven't seen it yet. And what Trump has promised, his latest promise is that today we're going to get a letter to Canada, or to the European Union, excuse me. So that would be coming today with Trump dictating rates, and would be a kind of negative end to this week that had optimism on the European Union front, depending on how he does. Again, everything is leading to this August 1st deadline. The response from Europe all week, as I should mention from Canada in response to this, is we're going to keep talking. We're looking to August 1st now. So nothing is set right now, but the European Union is definitely the other big thing we're watching today.
And Lou, I want to bring you into the equation because we've seen this taco trade at action, right?
Yeah.
There is this expectation that markets can continue chugging higher, even amid all these tariff unknowns. Is that naive thinking?
I don't think it's naive until we have data that proves otherwise. I mean, if you look at this, I don't envy Ben's position. Like, you're trying to untangle a bowl of spaghetti to figure out what tariffs are going to have what on them, what goods. But if we look at the headlines, I would say this: the data based upon the headlines, if you look at Japan and South Korea, 25% tariff, because they only account for about 8.2% of imports to the U.S., that would tick up CPI 0.2 percentage points at the most, is the estimate. But now we have to see, is that the reality, right? When the data starts coming in, when we get the next CPI report, are we seeing any impact? But by and large, I think investors have rightfully looked past tariffs because the president can't make up his mind. Is it today? Is it tomorrow? Is it next week? Is it 25% or 100%? And yet we haven't seen it show up in the numbers yet. So I think investors are more focused on earnings, and rightfully so. We're gonna get bank earnings and we're gonna get Netflix and start getting into tech earnings, which really have been driving the markets. And that is, I think, the biggest thing that's on everyone's mind and will drive valuations too.
And to that point, we've seen various sectors like tech, communication services, industrials, financials, trading near record highs. So what do you make of the recovery that we've seen since the April lows there, Lou?
I love it because everyone panicked, and then really the fundamentals underlying and underpinning the market have been strong in most of those. I mean, if we look at financial sector alone, I mean, I believe it's up 20% over the last year. It's been the top performer in the last 3 months. The only laggard that I see is energy, ironically enough. I mean, it's really struggled. It's the most undervalued sector in the S&P 500 at about 15 times earnings. So I think you're going to see here, as we come through this earnings season, people are going to start looking for more value, right? We're getting stretched on the valuation front. Everyone's starting to talk about it more. Where are those pockets of value in the market? You're seeing some in pharma and biotech, obviously the energy space, but then tech is still going to lead the way because we're getting more IPOs now, right? We're bringing out new opportunities to invest in. I mean, look at how well CoreWeave has done since it's come public. Other IPOs that had been waiting to go and launch probably will pick up a lot of the capital that's looking for new opportunities.
Yeah, and a good point there because it's been interesting to see some of those momentum trades in the IPO. You mentioned CoreWeave, also Circle, a stablecoin player. But thank you, Ben, for joining us. And Lou, you'll be here for the entire morning, so stick around. All your markets action ahead. Stay tuned. You're watching Market Catalysts. Nearly 1 hour into the start of trading, let's take a look at the trading action. Again, we're seeing a lot of red on the screen. The Dow is off around 260 points here. You're taking a look at a year to date right now. We're up 4%. If we take a look at the intraday, not as good. The Nasdaq Composite is down around 0.2%, and the S&P 500 is down around 0.4%. We did see record highs with the Nasdaq and the S&P, and in particular, something that stood out to me was Nvidia. It stood out to a lot of people out there. You're looking at total market caps here. Nvidia is now firmly trading above that $4 trillion market cap, the first publicly company to ever get that done. And Lou, I want to bring you into the conversation here because this is something that we've been discussing, right?
Yeah.
Whether Nvidia can go higher from here. And there have been some Wall Street strategists that are saying a $6 trillion valuation is on the table.
I know.
Is that a realistic
I've
opportunity?
scratched my head sometimes, but then Dan Ives and I got into it arguing, and then he convinced me.
Well, he's a big bull.
He is a big bull. But
yes.
Here's what I'd say. Momentum's on their side, not just in the stock market, but in the business. If you look at it, I mean, the data point that stands out to me, 1 full percentage point of GDP growth last quarter came from AI spending. So this is a huge trend that I think people are still getting their arms around how big it can get, how many trillions of dollars are going to be spent on it. And momentum's powerful. I mean, if you look at Nvidia's stock, it's gravity defying. But look, I think 5 trillion is probably in the cards. 6, I'm not ready to go there yet based upon the business fundamentals.
5 trillion though, wouldn't be too shabby. And like you're saying, momentum is certainly a big theme.
I thought Apple would always be the first one to do it, but apparently not. They don't get that crown. They get 1, 2, and 3, and Nvidia gets the 4 trillion.
Apple has struggled a bit this year. It's still in the $3 trillion club, so we'll give it that. But speaking of some of these tech names, I want to take a look at trending tickers. So let's play that. We're watching Netflix, Levi's, and crypto stocks. First up, Netflix getting an upgrade from Needham analyst Laura Martin, raising her price target to $1,500 a share. Analysts pointing out that the stock has earned $2.78 billion per full-time employee. That's better than large cap tech companies and members of the Mag 7, including Apple, Meta, and Google. This comes ahead of second quarter earnings for the streamer. And still with me is Lou Bassanisen. Lou, this is a company I cover closely. It's been looked at as a defense play amid some of this volatility.
Yeah, it's wild to think Netflix defense, but
right, exactly.
Yeah.
And you just look at the stock chart. It's just exploded here. I mean, we talk about momentum a lot. Is Netflix one of those names that you see to continue to chug a little higher?
Yeah, I think it's momentum. I can come around the defense because who's going to give up their Netflix subscription, right? No one's even thinking about that. I think what's really interesting is looking at it, as you mentioned, on a revenue per employee basis, because when you think about what's happening in the world with AI and the productivity gains you're going to get, we need a better way to measure that than traditional productivity. And I think this is the metric that you're going to see most analysts start focusing on across companies. We're going to say, hey, everyone's employing and deploying AI throughout their ecosystem and through their business. How is it impacting the fundamentals? And I think that's what you're going to see. So AI is not going to take your job, but someone that knows how to use AI is going to take your job. And I think you're going to see that show up in revenue per employees.
And to that, yeah, and to that point, productivity gains, I've been reading a lot of commentary on Wall Street that it's undervalued based on where we're currently at. They're saying that lawyers, writers are not actually telling you how much they're using AI to help with their job.
Yeah, they don't want to admit it, but
like you said, it is productive. And during the month of July, Netflix has underperformed here. Do you think it's a healthy correction at this point?
I think it's always good to see consolidations, right? I think I'm not someone that looks to buy stocks really close to earnings because you're about to get it. And Netflix has been historically very volatile around earnings. Used to really be volatile based upon subscriber ads. I think everyone now is rightfully focused on the strength of the revenue and profit and content spending. So I do think it's probably overdue for another rally. But again, 6 days, 7 days ahead of earnings, I'll wait and would rather pay a little bit more for certainty than chase it here.
Hot take here. I'm waiting for them to announce, a stock split or something like that.
Yeah, I think they would. They should.
Yeah,
I mean, you've seen
it's
everyone
expensive. Yeah, I would like to get in on some Netflix. We'll see. Next, shares of Levi Strauss higher after a second quarter earnings beat and confident outlook despite President Trump's trade war. Levi raised its full year guidance for both earnings and revenue. The company expects revenue to grow by 1 to 2% in the year despite a minor hit from tariffs here. So more signs of confidence here that tariffs not really throwing off these major companies.
Yeah, and I think this is symptomatic of what we've seen. So far, companies have tried to absorb the impact of tariffs as much as possible. And it makes smart business sense. If you can be dynamic and you have the margins, and right now, S&P 500 companies have 12% profit margins on average, which is 3 consecutive quarters of double-digit profit margins. They can take the hit because it's harder to get new customers than it is to keep your existing ones. They know they don't want to destroy demand if they keep passing on tariffs. I mean, if we think about it, think about eggs here in New York City, right? You think twice when you have to pay $12 or $13 a dozen versus if someone else can absorb that price. So grocers don't have much margin, so they have to pass it on. But imagine if everything was priced like gasoline, where it was changing every day based upon the commodity and the impact on tariffs. Too many businesses would be at risk. So I think Levi's is a bellwether showing that companies can weather this storm. They can move through this tariff uncertainty because we were talking about earlier with Ben, what is the tariff rate, right? I mean, it changes every day. The time that it gets implemented changes and keeps getting pulled back and extended. So we just don't have it in the data yet. We don't know what it is. So I think this is a strong sign for the rest of the market that Levi's saying like, hey, we got this. It's not that bad.
Yeah, and Levi's also saying that they want to absorb some of that tariff cost. I just wonder what that actually means in practice and when that stops. When do you hit the point that you can't keep absorbing and have to pass on some of those costs?
I think that's the pain point that we can't figure out, right? For each company, it's going to be different. And then I think you're right. If you start seeing companies saying like, hey, tariffs are really impacting us, the market's going to have a different tone and trade differently. Not going to be at all-time highs if a lot of companies are saying that.
We have the CFO and Levi's on later in the show, so I'll have to ask him that. But finally, crypto stocks are moving higher after Bitcoin topped a new record high above $118,000 a coin. Crypto-related stocks like Coinbase and Strategy all higher as the cryptocurrency approaches the next milestone of $120,000, breaking above the $100,000 range where it's hovered since November of last year. And Bitcoin, I remember late last year we were around 70,000, 80,000. Now the fact that we're talking about 120,000 is insane to me.
It's crazy. I should have known because my dad asked me when I was about 75,000. He's 76 years old. He's like, I think I'm going to buy some Bitcoin now. And I'm like, don't do it. That's probably the worst time to do it. And lo and behold, he should have. I think we're in uncharted territory. I mean, we know that. So I've looked in some of the guys that are in the space that I deal with and compare notes. They think 140 is really. So we get through this 120, 126 range, and then you're looking at smooth sailing to 140,000. So I think it's probably in the cards simply, again, we talk about momentum, but then all of these digital asset treasury companies coming to market are soaking up so much supply that if you get any new buyers coming in, it really drives prices higher.
And we've heard President Trump talk consistently about crypto, about Bitcoin. You were just talking about your father wanting to get in on it. Do you think that the fact that it's part of the conversation now, there's been a lot of crypto adoption, how has that helped fuel this rally?
I think it absolutely has, because if we go back, go 5 years years ago, there was no mainstream awareness or adoption of it. So I think you're seeing, this is a classic new tech adoption. You've gotten across the chasm of just early adopters to now where everyday people are thinking about, how do we do this? How do we invest in it? I think the trend of bringing, the Bitcoin holding companies public makes it much easier to invest in Bitcoin. It's much easier for institutions because some of them can't custody crypto, right? Now they can because it's equity. And now you have all the derivatives that you can trade off of that to really make it an optimized investment. So you can sell covered calls against a stock. You can trade options around it to create even more alpha. So I think that's what's driving a lot of this. And so it's interesting. I don't think we'll ever have a day where we're going to be paying in Bitcoin on our phones at the corner store, bodega, for whatever we want. I don't think we'll get to that type of digital currency with Bitcoin, but it is going to find more mainstream uses.
Yeah, and there's so many offshoots of crypto, right? When we talk about tokenization, stable coins, so we'll see if Bitcoin can hit that $120,000 mark. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your market action straight ahead. Stay tuned. You're watching Market Catalysts. Big bank earnings on deck. Investors are looking for a clearer picture on business trends and what the biggest lenders are saying about the state of the economy. Joining me now is banking reporter David Hollerith, Gerard Cassidy, RBC Capital Markets analyst, and Lou Bassanese, Prairie Operating Company's EVP of Market Strategy. So David, let's start with you. Expect it to be a big quarter here for the banks. What are you looking for?
Yeah, I mean, to start it off, I think you kind of laid it out. We're going to want to see starting Tuesday from JP Morgan Chase, Morgan Stanley, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, what their second quarter actually looked like. If you remember going back 3 months ago, things were quite gloomy. And although first quarter results were good, it was kind of a dire state. Stocks were plunging, and a lot of top bankers were asked to sort of prognosticate on their views of a U.S. recession. And since then, the picture's gotten a lot more optimistic. And really, next week, we're going to want to see, how optimistic the banks are looking towards the second half of the year.
And Gerard, we just heard David walk through some of those broader expectations here. Is there a particular bank that you're most bullish on, or that maybe you want to hear a little bit more clarity on the path forward?
I think what we're going to see is that all of the banks will have similar results when it comes to capital markets. They've all obviously play in the same marketplace, and many of them are going to show better trading results, particularly in equity trading. Investment banking numbers not as strong because of the uncertainty that David just talked about in the last 2 or 3 months. But when you specifically cite a name, Bank of America looks to us to be one of the more undervalued names. So I think that's a focus people are going to look at when it comes to their net interest income growth. Citigroup is another one, particularly when it comes to the stock buyback. Here you have a company that has the ability to buy back more of their stock more aggressively. And we have to remember, many of these banks came through a very rigorous stress test with very good results, and it freed up capital. So I think you're going to hear a lot of the banks talk about this excess capital and how they may redeploy it by buying back their stocks more aggressively over the next 12 to 18 months.
And Gerard, you mentioned uncertainty, especially around Trump's trade policy. What have we heard so far when it comes to the banks and the business demand that we've seen there? And since we seem to have reached peak uncertainty, is that demand expected to improve?
It's a really good point, because incrementally from the first quarter, when you think about when the banks reported results in April, it was at the height of the uncertainty due to the tariff situation. And I think we're going to hear incrementally it's going to be less bad, if you will, about that uncertainty and the impact it's having on loan growth. So I would look to the banks being more encouraging about the second half of the year loan growth. And I would also point to every Friday afternoon, the Federal Reserve H8 data comes out, and that data is, starting to show a little better loan growth as well.
And Lou, I know you're focused on executive commentary from these banks when it comes to interest rates, the Fed's next move. We did hear from Jamie Dimon that the market is currently underpricing higher rates. Do you think we'll hear that concern from other executives, or do you think they're going to be a little bit more dovish?
No, I think Jamie Dimon really loves his spot being a contrarian right now. He always seems to be an outlier. I'm looking for the commentary on Fed, obviously, but also just what they're talking about investment banking, right? The outlook for M&A activity. In April, we hit a 20-year low. We've obviously rebounded out of that as you see big deals like CoreWeave buying Core Scientific, a lot of acquisitions now, Merck, a $10 billion acquisition in the pharmaceutical space. So what are they seeing on that front, on the IPO front? And then also, I'd be curious, with Bitcoin hitting new highs, what commentary we get out of the big financials about Bitcoin, because it's a momentum play. They have to integrate it into their system at some point. All in all, I know we were looking at individual names. The sector alone, I mean, the S&P 500 financial sector is up 9% year to date, but 20% in the last 3 months. So it's really rebounded well. I think this momentum is going to continue. So I think it's a great sector to be in as an investor at this time of the market.
Gerard, do you agree with Lou that Bitcoin integration for these banks is inevitable?
I'm not in the Bitcoin camp being a mode of monetary transfer. However, stablecoin, it is here. It's going to stay. Bitcoin is like gold. It's an asset. It's always going to be there. Don't get me wrong. But what we're going to see is stablecoin is going to make huge inroads in the payments business over the next 10 years. And it will impact the deposits. But I think the banks, don't get me wrong, they're not going to sit on their hands. They're going to be very active in the stablecoin market over the next 3 to 5 years.
And Gerard, we were just talking about the Fed, obviously closely watched by these big banks, but also the regional banks too. If we are in this higher for longer camp, how much pressure does that put on the margin side for regionals? And are you bullish on regionals, or would you rather just stick with the big guys?
It's going to be interesting because think about all the assets that were purchased by the banks, the regional banks back in 2020 and 2021 at yields of 50 basis points to 150 basis points. As those assets reprice into the higher for longer marketplace, they're picking up 200 to 300 basis points in yield. Their funding costs are not going up. So believe it or not, higher for longer is not necessarily bad for the banks. Ideally, though, what we would see and why we think regionals could outperform the money centers is if the Fed cuts 25, 50 basis points between now and end of the year, the yield curve steepens and you get a positive slope. The last time we had a Fed funds rate over 3% with a 75 basis point slope to the curve was 20 years ago. And investors may not remember that, but that's very positive for the regional banks. So if you're in the camp that it's higher for longer, but we do get a cut or two, boy, oh boy, that could be very positive for the regionals.
Interesting. What names within regionals?
Pardon me?
Which names?
Oh, on the regional, yeah, thank you. Yeah, so the names we would look to would include Fifth Third out of Ohio, Regions out of Alabama, M&T Bank up in Buffalo, New York, are all names that would benefit from this environment. Key Corp on Ohio as well, big beneficiary of this.
All right, and David, final one to you. M&A has been at depressed levels for quite a bit now. What's Wall Street saying about the potential pickup in M&A?
Yeah, I think it's hard to really make it out, and that's what we're trying to hear next week. But I think generally there's a lot of optimism. Sometimes there's sort of a joke that there's always optimism about M&A picking up. But there has been some more clarity, and the bigger players, the big corporates, private equity, for example, they kind of have these drivers to where they might not be as, or they might be more immune to tariffs. So they're able to, kind of take these deals and turn around and move forward with the transaction. What we're hearing from smaller companies, the middle market, is that it's much harder to move forward with the uncertainty of tariffs. So they're still waiting to that play out. Just across corporate America, everybody starting in April kind of had to go and dial back their deal, or at least pause it, to look at how tariffs could affect them. And so they all created a model, and now they're kind of operating off those models. But as we see, the actual effects of tariffs sort of seem to be changing per day. So there's still a lot of uncertainty around the deal market. Bigger deals have a little bit of an easier chance.
Yeah, uncertainty, the word of the day, the week, the month, the year. Thank you, David, Gerard, and Lou. Appreciate it.
Thank you.
All your market action ahead. Stay tuned. You're watching Market Catalysts. This week on Opening Bid Unfiltered, Yahoo Finance executive editor Brian Sazi spoke with Nicolai Tangen, CEO of Norges Bank and leader of Norway's sovereign wealth fund. That owns almost 1.5% of all shares in the world's listed companies. Tangen took us inside what his firm does. Take a listen.
So when they found the oil in Norway in 1969, they decided to put it into a fund. In some countries, they had spent the money, but in Norway, they decided to save it instead. And so they kicked off the fund in 96, and it has grown to roughly $1.7 trillion. And we invest globally. We own roughly 1.5% of all the listed equities in the world. We have a large bond portfolio, and we own a lot of properties and renewable infrastructure. So that's what we do.
The returns that the fund makes, where do they go?
Well, they go into the state budget. So first of all, we spend roughly 3% of the fund every year, and that accounts now for more than 20% of the Norwegian state budget. So it kind of pays for 1 of 5 schools, hospitals, roads. That's how it's spent.
I just want to bring that stat you mentioned right back up here. Owns almost 1.5% of all shares in the world's listed companies. I mean, that's a big responsibility.
Yeah, it's a big responsibility. But I would say we are helped by the Minister of Finance, which make a very good mandate for us, which we follow. So we are relatively index near in what we do. And then, of course, we are 700 people here working hard day in, day out. So it's not my responsibility alone, thankfully.
How did you get into the field of investment management?
I just love it, right? I think it's the most interesting job you can have because in investing, you have to be on top of the companies, what they make, psychology, geopolitics, defense, all these kind of things. And it changes just all the time. And in particular now, things are being turned upside down every so often, and combined with huge changes in geopolitics and technology development, I think just makes it the most interesting place you can be.
How are these changes geopolitical things have certainly gone upside down. It's been quite the past 6 or 7 months. How has that changed how you go about putting money to work?
Well, they changed very little in terms of how we go about. And I think that's the important thing, because when you are in a situation where things change so fast, very often doing little is the most difficult thing. And I think this is an environment where it's a huge advantage to have a strict mandate and a very, very long time frame on what we do.
You, I would imagine, have a unique perspective on the United States. Here in the United States, lots of conversation on President Trump's tax bill, what it might mean to deficits, and the general thinking is this is going to add big time to deficits. From your perspective, how do you view the U.S. economy?
Yeah, we first of all, we never have a view on politics, okay? But what we do have a view on, of course, is some of the effects of politics. We do observe that the budget deficit is quite large. That's not only the case in the U.S., but across the world, right? We are at roughly $100 trillion, according to IMF. And the question is whether there will be a time where investors will certainly think, hey, we want a higher coupon for lending money to these various governments. And that's potentially when we could see a kind of an uplift in interest rate levels generally.
Does that change how you invest? And I bring that up because I view what you do as you're the ultimate long-term investor. You're putting money to work today that will earn a return 5, 10, 15, 20 years down the line. But if our debt levels in the U.S. are going to go up pretty significantly off of already high levels, does that change how you think about businesses?
Well, of course, it helps to be the reserve currency of the world, right? So the U.S. is in a bit of a special situation here, but you never know when the point is coming where investors suddenly decide that the debt level is too high and we want a higher price.
So you own close to 9,000 stocks. Like, why so many stocks?
We basically own the world, and I think when you are such a large investment fund, you need to be widely diversified. And so what we have a mandate which is telling us to be to be widely invested. We are now roughly just under 55% invested in the States, and the rest is in Europe and the rest of the world. We've got roughly 70% equities and 30% bonds. And so I think to be widely diversified and really long-term is the way to navigate these markets.
Within the portfolio, you do have a pretty large bunch of holdings in tech. I mean, I look on Yahoo Finance, you can see you're a top holder in some of the biggest names like Microsoft, Alphabet, Meta, you name it. Why do you like tech?
Well, we are, when companies do well and get really, really big in terms of market capitalizations, we own automatically quite a lot of it, okay? So Microsoft is our biggest holding, and that's because it is a very, very large company. Now, what we are seeing is that we have a bigger concentration level in the portfolio than we've had in the past. So now our top 10 holdings will account for 20% of the fund, which of course is a different type of risk than we've seen in the past, in particular because the largest holdings typically are all tech related. And so this type of factor risk we for sure haven't seen before.
I imagine, and I don't want to put words in your mouth, Nikolai, but this large concentration in tech names, this is a really strong bet, I imagine, on the future of AI impacting so many parts of the world.
That's true. And, we are, for sure, AI will have a huge impact on how we work. We are seeing it. We think we increased productivity by 15% last year by utilizing AI in everything we do. We think we can open up another 20% productivity gap this year by, again, just making sure that we get the message across from the top. We have ambassadors being trained in AI several times a week. We have mandatory events across the firm. So we really kind of carpet bomb the organization with AI initiatives, and it really works, It's driving productivity. We're getting rid of some boring tasks, and it's super interesting to see what it does to us.
Well, it makes you...
Now, whether the valuations of the companies is more than discounting this, I think is very, very difficult to say.
Well, yeah, let me lean into that, because as an ultimate long-term investor, is it hard to identify when a stock might be overvalued? I mean, because theoretically, you're holding for years. So who am I to think that Microsoft is overvalued here in 30, 40 times earnings? Maybe it grows even faster.
No, I think you're right. I think it's very, very tough to know when things are overvalued. I mean, generally speaking, I think it's easier to see when something is undervalued. I think it's easier to see panic. I think it's more difficult to see euphoria and greed and really know when to exit something. That's just a general observation I have after having been in the market for a long time.
Are we seeing euphoria in markets today? Markets around the world hitting records?
It's a difficult one. I think we are seeing some signs of euphoria. But whether that's it, I think is very, very tough to say.
Why do you think investors are so optimistic?
Well, I think investors are optimistic partly because of the prospects of what AI can do to productivity and what it can do in terms of holding price increases down by improving efficiency. And now, of course, you also have the humanoid robots coming, which will make sure that we are in a situation with excess supply of labor. So, there are some positive long-term scenarios here.
You mentioned...
I think also it's difficult to know what's the alternative to having money in the stock market. There isn't any, it's not an easy answer to this.
But you also own a good bit of real estate.
Yeah, we do. And we have continued to add to our real estate holdings. We have nearly 1,000 properties around the world. We have big holdings in logistics. We own, quite a lot of property where you are sitting in the middle of Manhattan. Also in many European cities such as London and Paris.
You mentioned at the top, briefly, some of the things you look for when putting money to work, but you mentioned psychology. How important is psychology for you before putting more money in a stock?
Well, I would say generally psychology is just super important. And you have to identify these situations where you are right and nobody agrees with you, right? And I think it's very, very important to identify the level of panic where you wanna add to your holdings, and of course the levels of euphoria where you wanna take some off. So observing investor psychology is one of the most important things I do.
Where, outside of your holdings in tech, Nikolai, where else are you concentrated in terms of stocks?
Well, we would have a portfolio which reflects everything that goes on in the world, right? We have big holdings in the big consumer companies. We have holdings in the energy companies. We have big holdings in pharma. So we would be most places.
Are you? I imagine. What's your view on green technologies? Of course, Norway has been drilling for decades. How do you have money to work in that space?
Yeah, we do. We really believe in some of the large integrated energy companies, and we also have invested in renewable infrastructure in Europe and in the US. Now, we appreciate that these type of assets are not really in favor for the moment, which gives us a good opportunity to add to our holdings there. So we think we'll get better returns in some of these projects than we got in the past.
Intel is outperforming the broader market year to date, up around 19%, but when you zoom out, you see a completely different story. Intel used to be the big player in the computer chip space, but it's since fallen behind, particularly when it comes to the AI boom. Many investors say Intel missed the AI transition, while companies like Nvidia and AMD forged ahead. Intel is down around 60% over the past 5 years. That compares to Nvidia's 1,000% plus record run. 7 months ago, Lou Bazani's Prairie operating EVP of Market Strategy joined Julie Hyman on Yahoo Finance's Goodbye, cautioning against Intel. Take a listen.
If you knew nothing about this company at all, if you didn't know what it was and you looked at the chart, you might think, maybe it's getting to a bottom?
No, I'd think a penny stock that's going to bankruptcy.
Okay,
so,
wow, all right. So we just don't know what's going to happen with Intel.
It is. Turnarounds always take time, and especially when you have to bring in a second turnaround leader. It's not something where I think you want to put your capital when you have other opportunities out there that have a much more clear-cut path to get to that turnaround. So yeah, it can be attractive and compelling, but when's the last time you really heard anything buzzy about Intel Inside? It's just not. It's one of those legacy brands that everyone knows, household names, that aren't household investments anymore.
All right, Lou, 7 months later, we forced you to watch yourself back.
I know. I'm just glad I'm not wearing the same jacket because that would have been embarrassing.
Well, Intel up 20% now. Do you still stand by that skepticism?
I do. So that was the beginning of December. So it's down about 2% since then. I think what strikes me, looking back 7 months later, is that there are other opportunities out there, right? So I made the right opportunity cost allocation. I just don't think that it's going to ever be a leader. Now, you don't have to be the leader to actually make profits from AI. I don't think it's a zero-sum game. But for me, Intel, it's still in a turnaround phase, right? I mean, the most rallies have happened when they announce layoffs, which is just counterintuitive, right? I want to own stocks that are announcing positive fundamental growth, positive business developments. I'm not looking to, can you cost cut your way to being relevant again? And it's just not there for me. I think there's just other opportunities. Do I think the company is going to be doomed and never succeed? No, not at all. It's a very solid company, strong leadership. They have a legacy business that will find its way and its footing in here. The foundry is really attractive to me if they spin it out. I think that makes it a real interesting story at that time. I'd reconsider it then. But yeah, I'm okay not owning Intel still.
Okay, well, speaking of spinning out, they are spinning out its artificial intelligence arm. This is going to be known as RealSense, so a bet on physical AI. I mean, how do you view this move, especially as an Intel skeptic?
Why spin out what could be your biggest asset, right? I think I would lean into that and say, like, we're moving more into AI. Here is the proof point of that, and then drive that into the rest of the organization as, hey, if you want to own this AI asset, you got to own Intel. So in that case, I don't think it makes sense to spin out.
Do you think it could compete with Tesla, Nvidia when it comes to robotics?
I'm not on the robotics train yet. Everyone believes that humanoid robots are going to be, ubiquitous in 10 years. I just don't see it. I'm not paying $30,000 for a robot to turn on my lights and maybe make me a coffee. But I do think you're going to get more commercial applications, industrial. We're seeing that. Those are being deployed already. It's about a $30 billion market that's happening. So could Intel get into that? Yeah, I think there's possibility. Here's the biggest challenge for Intel. You're a huge organization innovating when you're that big. I mean, it's the same thing we talk about with Apple now, right? They're too big. They're really struggling, and I just don't know who wants to go work for Intel, right? We're seeing these talent wars happening in AI with Meta poaching talent. Is Intel going to back up the truck with offers of $100 million or more?
It's
I don't know.
not the shiny name.
Yeah, exactly.
You're right.
Well
Not the
played.
shiny name. All right, but the stock is still up around 20%, so we'll see if that turnaround can happen. But stick around, Lou, because coming up, we have full market coverage in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First, President Trump heats up his trade war with new threats to trading partners. Full coverage ahead. Plus, can the market euphoria last? That's the question as U.S. stocks drop after hitting record highs. We'll break down what comes next. And we dig into what to expect from earnings season as Levi's raises its guidance. Is the worst of President's trade war behind us? We'll discuss that and more on Market Catalysts. Well, 90 minutes into the start of U.S. trading, I'm Allie Canal, and let's get a quick check of the markets here. Taking a look at their major indexes, we're still seeing a lot of that red. We have the Dow off around 250 points. The loss leader here among the three majors, roughly down 0.6%. The Nasdaq has recovered a little bit from its lows, still down about 0.1%, and the S&P 500 is seeing losses of around 0.3%. And I quickly want to check on treasury yields, particularly the 10-year yield, because we are now seeing 4.41%. This is above the 4.4% that we've seen on a consistent basis recently. We are about 20 basis points off of the highs that we saw in April. So something to keep an eye out for, especially as we continue to wade through a lot of this tariff uncertainty, deficit concerns. And one thing I have my eye on is whether or not we could see the bond vigilantes return into this market. Well, even though supply and demand dynamics point to a surplus, the International Energy Agency warns the oil market could be tighter than it looks. That's driven by strong summer travel and power generation needs. Joining me now to dive into the latest trends is Bob Iacchino, Path Trading Partners Chief Market Strategist. Lou Bassanese, Prairie Operating Company EVP of Market Strategy, is here with us, and our senior markets reporter, Inez Ferre. And Inez, I want to start with you here because OPEC Plus decided to increase production this week. Just this morning, we heard that Saudi Arabia raised its own crude output far above its own OPEC Plus quota. Prices trading below $70 a barrel. So what's Wall Street saying about where we could be heading?
Well, long term, Wall Street is seeing oil trending lower by the end of the year. And part of that has to do, of course, with OPEC Plus increasing its output. I mean, if you take a look this week, though, we are on pace to close out the week higher. You mentioned that IEA report that's talking about surplus but tightness in the market right now. You also have rig counts that are lower week over week. So that's spelling some tightness. And then you've got uncertainty about what President Trump is going to say regarding Russia on Monday. But longer term, definitely, the street is expecting a lower trend for oil prices. Also want to note that JP Morgan noted in their note this morning that that big, beautiful bill that went into law, that also slashes the amount of money that the government will spend to refill the SPR for now. So that has cut some SPR funding. So you won't be seeing as much buying for that SPR. So that should put pressure on prices, as well as China has been increasing its stockpile, but they're getting up there in that peak. So what these analysts are saying is that you're going to start seeing some of that surplus in the Western market that should put pressure on prices later this year.
So, Bob, we seem to have a challenging medium-term demand environment, and Ez was just laying out the case that Wall Street has been making that we will see prices continue to decline. At what price point does this start to be a little bit concerning to you?
Well, I guess it depends on from what side you're looking at it. I mean, we know that Permian specifically and shale production in the U.S. generally is declining. And as you see pressure on prices, there's not going to be a whole lot of incentive for CapEx. President Trump came into office talking about deregulation and drill, baby, drill. But we all know from having discussed it for years that it's just not that simple. You just don't turn a spigot on and more oil comes out. Not to mention the non-fungible nature of the different types of crude oil. So when you're looking at to the downside, 40 to 45 is when I start to get worried about the overall effect to that particular region of the country. But when you're talking about the upside, there's a lot of room on the upside where there's not a lot of pain to the general economy. And I'm talking about versus today's price. We're looking at WTI at about 68, probably get to about 75, 78 before it starts to become worrisome. But this is the only part of the tariffs, in my view, that can be viewed as inflationary, is the tariffs on industrial metals like copper and energy producing countries like Brazil and Canada. That's where you start to get inflationary pressures. Otherwise, tariffs are a tax, and taxes historically are deflationary. So this is actually a problem for what the president wants to achieve, in my view.
And Bob, I want to talk about copper in just a minute, but Lou, you heard Bob mention drill, baby, drill. Yeah. You say that oil prices remain the enemy of that. Can you explain that take?
Yeah, I mean, Bob's exactly right. If you look at the Permian, you start seeing players like Diamondback dropping rig counts aggressively when you get around 60 and lower. So the president wants abundant and cheap oil. The problem is producers want abundant but not cheap. And, I work for a company based out of the DJ Basin. Our break-evens are a little bit lower. We're not as expensive full cycle costs as Permian because of just the interest that's been there. But you have to look at this. I mean, rig counts have been dropping. I think it's 7 or 8 weeks in a row. We're basically at baseline maintenance for rig counts. 440 some odd rigs in the U.S. For oil rigs keeps our production exactly where it is. But then you have shale production that continues to decline. So if you see prices drop, we saw it. I mean, you get closer to $60, I think you start seeing producers throughout the energy space looking really closely at their CapEx budgets and changing those. But to Bob's point, I think you're exactly right. It's in that $70 to $75 range is a sweet spot for the market, for the economy. Everyone can tolerate that, and it's actually great to encourage more independence for energy here in the U.S.
And Bob, for everyday investors that are watching these moves in oil, is now the time to get some exposure? And how can you trade oil without having to wade into those complicated futures contracts?
It's difficult. I mean, I'm not a giant fan of USO as an ETF, so I would be looking at more of the energy companies if I wasn't involved in futures. It's always been my stance that the thing that's most correlated to crude oil is crude oil. So if you really want to get exposure, the futures contracts is the way to go. But looking past that, I do really like Diamondback. I just don't like, that's the symbol's FANG. I just don't like the way the chart looks right now. It's actually got some stability lately, and it's something that I've been looking at, but it needs to base more than it already does. When you talk about the decline in production, as Lou mentioned, that's a big problem for the general well-being of the U.S. economy, just from a sort of momentum and an emotional standpoint for investors. Because there is just, to me, there's no such thing as energy independence. And when you've got the sort of trade tensions we have right now, you get further and further away from it. And the shale drillers are just not going to drill without some sort of incentive to do it. The CapEx is going to continue to decrease, in my view. So I worry about those companies. I need to see better chart patterns, but either way, FANG is my favorite.
All right, and I want to get to copper. That's something that you mentioned, Bob. And Inez, I know you've been speaking with strategists this week about what could happen next with copper after Trump threatened those 50% tariffs that are set to be implemented on August 1st.
Yeah, and we have seen copper at record prices. Look, I spoke to a mining and exploration company, and they were telling me that this has really thrown the market sort of into a tizzy because they were not sure what's going to happen next. With respect to imports of copper, the U.S. has been importing a large amount, trying to get ahead of these tariffs. But these tariffs were expected to be less than 50%. I mean, the street was expecting around 25% for copper price tariffs. So now it's 50%. And what market participants are also telling me is that the U.S. just doesn't have enough to process all this copper. There's the 3 smelters in the U.S. compared to China that has around 5 times more. So in order to get these smelters that process this copper, this takes years in the making to do. And this is what, for example, that exploration company was telling me was that that's the main issue that the U.S. has. But certainly, I mean, if you, in the near term, what the street is saying is that if you're going to put these 50% tariffs on copper, you're going to see even more imports, at least in the next few weeks, of copper trying to come into the U.S. ahead of those tariffs.
And Bob, I want to get your take on this because we've seen gold prices soar. Dollar obviously has not done well. Bitcoin has soared. And there's this argument that I've seen percolating on Wall Street that this is all a sign that investors are hedging against increased deficit spending. Do you agree with that?
Well, I mean, I hope they are, because it's clear that we're going to get increased deficit spending despite the tiff between President Trump and Elon Musk. It doesn't seem to be working. I think when you look at copper specifically, copper was already up over 24% year to date prior to this announcement. That extra 8% doesn't really help. Now, again, you're looking at it from the supply side inflationary level. The big, beautiful bill is big. I don't know if it's beautiful yet, but it's definitely a stimulative factor. And when you combine that with having a Federal Reserve that isn't talking about tightening policy at all, I'm not saying they should, but it's not in the conversation. They're either neutral or easing, which is also stimulative. And you could end up in a very serious situation for the economy where the Fed can't really help.
All right, we'll have to wait and see. Bob, Inez, Lou, thank you so much. Coming up, the most valuable private company just reached a new financial milestone. That's next. Elon Musk's SpaceX is reportedly planning to sell insider shares at a valuation of over $400 billion, making it the most valuable U.S. private company ever and topping its own record-breaking $350 billion valuation from last year. The new funding comes after a catastrophic failure for a SpaceX Starship launch in Texas. That saw the rocket explode ahead of a routine launch planned in June. It also comes as SpaceX founder and CEO Elon Musk has been embroiled in a feud with President Donald Trump. That included Trump threatening to cut any government contracts to Musk's companies. SpaceX has received billions from the U.S. government, including 4 contracts in fiscal year 2024, totaling nearly $3 billion. That's according to usaspending.gov. The company also sees revenue from its Starlink satellite business, and according to Bloomberg, Starlink accounts for about half of SpaceX annual sales. And if you take a look at the Yahoo Finance private markets data, you can see here that SpaceX's $433 billion valuation is well above the next most valued private company. That's OpenAI, the company behind ChatGPT. That's valued at $324 billion. Other AI names like xAI and Anthropic still hovering below that $100 billion valuation threshold. Well, ex-CEO Linda Yaccarino announcing her departure from the company this week. So far, no successor has been announced, but with SpaceX reportedly looking to raise additional funds, what could this leadership change mean for CEO Elon Musk and the space economy more broadly? Joining me now for a closer look into how to play the space economy is Chad Anderson, Space Capital founder and CEO. Also with me is Lou Bassanese, Prairie Operating Company EVP of Market Strategy and founder of thebigskinny.com. So Chad, let's start with you. We were just talking about SpaceX, hugely valued company, but we have this news that Linda Yaccarino is stepping down. There's been this thinking among investors in Tesla, for example, that Elon Musk is constantly distracted by different things. For SpaceX, is that a concern for you?
So we're going to talk about SpaceX for sure, but the space economy is much broader than just SpaceX and Elon Musk. It has gone, it is no longer a venture-only curiosity, it is now a macro relevant asset class that is reshaping defense, connectivity, and global intelligence. Just this quarter, there was $7.8 billion invested into 113 companies across the space economy. So there's a lot more going on here than just SpaceX, although SpaceX is certainly the apex player. They have held the dominant position over the last decade or so. The only reason that we even talk about space as an investable category is because of what SpaceX has done. So yeah, I mean, look, there's a lot of noise going on, but there usually is in when you're talking about Elon Musk. I don't think that this is really new. It's just different.
What about the president threatening to pull those government contracts? Because that is very important for SpaceX.
Certainly. I mean, this is something that we're keeping an eye on, right? I mean, anytime that you get involved in politics, you're going to ruffle some feathers and you're going to make a certain group of people upset. You know, there's also benefits. So there's benefits and costs to getting involved in politics, and he got involved in a very major way, right? SpaceX is very heavily dependent on the government for revenue and contracts, but the US government is also very heavily dependent on SpaceX. This is the most important company in the world in terms of economic growth and national security. So the U.S. government needs them as well. So there's also this really interesting tension on both sides.
And you brought up national security, and that seems to be a huge priority for this administration in particular. So how can you maybe utilize what's going on in D.C., what the president wants, to fund a lot of these companies, or at least make headway there?
Yeah, I mean, that's a big talking point for the quarter and what's going on here, right? Defense is a key area of opportunity. One of the most tangible areas in which this is starting to manifest itself in the space economy is the Golden Dome initiative. We don't know how big that's ultimately going to be. There hasn't been a price tag put on this. In the big, beautiful bill that's come out, there is $25 billion set aside for that as sort of a getting started point. This is going to be a massive program that involves many space companies doing a lot of things. SpaceX was in pole position, to win a significant amount of those contracts. How is that going to play out now? But basically, every defense incumbent and every startup is going after this program and trying to get a piece of it.
Interesting. That's an interesting program. So how can you play that in the public markets, or is this mostly focused in private markets right now?
So what's going on in the space economy is early. It's really, again, on the heels of SpaceX, so we're like 15 years into this. We are starting to see some of those companies go public now. And they're really playing up the space and defense angles because there is a lot of government dollars and there's a growing amount of commercial dollars being made available. So we saw 20 exits in the space economy in Q2. 2 of those were IPOs, although there is probably worth talking about. Those companies, I mean, there's companies that are really good at playing the hype game, and then there's other companies that are actually making real revenue. So.
And SpaceX, I mean, valued at over $430 billion. Why haven't they gone public yet?
Well, I mean, if you think about why you go public at all as a company, it's probably to tap into the public markets and to the liquidity, right? Well, SpaceX is the most valuable private company, as you just mentioned. There is more demand for their stock than there is supply, by a lot.
Okay. Lou, I'm curious, would you invest in SpaceX if they went public? Or is this an attractive opportunity?
It is. I think it's an attractive opportunity. I would look at, as Chad was saying, there's not many options. We're still early in this. If you got a chance to invest in I would liken SpaceX to the Nvidia of AI, right? I mean, Nvidia is the apex player there. SpaceX is in space. I also like to look for what are the enablers, right? So right now there's not many public options. So if you look at like a Teradyne, a semiconductor test and equipment company, they're going to be involved with more space technology over time. So you can't get a pure play, but I would look for those adjacent companies that are going to start doing more space, investments in business. I struggle with companies like Rocket Labs that's up 600% over the last year. That's one of the well-known names in the space trade, and I just have a hard time trying to justify a valuation there and chase that type of momentum. So I'd look for more undervalued names. I mean, there's a couple ETFs that have space exposure, but they tend to be defense players like Boeing, Lockheed Martin. So there's really, like Chad was saying, there's more opportunities coming, but we don't have a rounded out list yet of available options.
Right, and Chad, you've also said before that the space economy isn't all about rockets to the moon, right? So what are some of the other growth drivers there, and where are you seeing that momentum?
Absolutely. I mean, most people think about rockets and the Apollo moon landings and like these sort of big government programs, but it's really, we're focused on the infrastructure, like the satellites that are in orbit, but also how that infrastructure is being leveraged here on Earth. So the intersection of geospatial and artificial intelligence is a key area of opportunity for us. We have massive data sets that we've been collecting with satellites for decades. We now have, with SpaceX enabling access to orbit, we now have a whole slew of new companies that are launching all types of new sensors. We have this unprecedented amount of really valuable data about the surface of our planet, the movement of goods. AI is enabling us to unlock the insights from that really valuable data set. And so this is a huge area of opportunity for us. We've just announced a couple of deals that we did in the last couple of weeks. One was yesterday. In this area, we're putting money to work, and we're early here, but there's a lot of value to unlock. And I think that these are the types of companies that do well long term and in the public markets. There's massive demand pent up, and their software, they're low capex, and the TAM is huge.
All right, a lot of signs to look out for. I'm excited for when some of these companies maybe do go public in the future. Chad, thank you so much.
Thank you.
And Lou, you're going to be sticking with us. Much more market coverage straight ahead. You're watching Market Catalysts. 2 hours into the start of trading, let's take a look at the markets. We're still seeing a heck of a lot of red. In fact, we're actually seeing losses accelerate a bit as we head into afternoon trade. Losses are being led by the Dow Jones, down around 0.7%. Tech-heavy Nasdaq Composite down around 0.2%. The S&P 500 hovering down around 0.5% there. And this comes as we've been talking about a lot of trade and tariff headlines, investors having to wade through that data. If we take a look at a 5-day, despite the record highs that we saw for the S&P and the NASDAQ, we are unfortunately down for the week, I think across the board. Yeah, just couldn't get it done this week, it looks like, but we still have a lot of trading left. If we can power through, that would be a good thing. One, currency that's continuing to be on the move is Bitcoin. We're seeing the token trade close to those highs of around 118,000 a coin. We are up around 8% over the past 5 days here. And Lou, I want to get your opinion here. 120,000, that seems to be the next big catalyst. Do you think we're going to get that pretty quickly, or do you think we could see some choppiness before that?
No, I think we're going to get it very quickly. And I'll give you some data behind the reason why we talked about it a little bit before, is you're seeing a lot more of these digital asset treasury companies come to market. And I'm on a board of a company that got approached to do this and diversify into a Bitcoin strategy. There is really what seems like unlimited demand of institutional money for these strategies, which is going to drive prices higher, take more supply off the market. I wouldn't be surprised if we're sitting here next week at the same time as we're talking about 140, right? We've blown through 120,000. So
wow. Okay.
I think this is just one of those trends. This is, we talk about playing into the hype and the momentum. This is definitely Bitcoin right now. Yeah.
And going back to that, you're on that board of that biotech company about the crypto treasury. What were the conversations that led to that decision? Why have this exposure?
Yeah, I think it's a decision now, without speaking out of turn, that a lot of companies are having because it can be incorporated into, it's a way to facilitate owning crypto. Can we still run our operating business and not be distracted from that, but also raise additional capital and bring in another investing class? So for us, we were a very small company. We can run our operations with a medical device very cheaply for about $300,000 a month. So for us, this is a way to broaden out the reach and the potential for the company and also tap into something that's very popular in the market because it's the right vehicle. It's a more efficient vehicle. I'm not just talking about this company, but owning Bitcoin through a publicly traded vehicle is a lot less friction. You're really seeing the way that these trade is a multiple of their net asset value, right? So you see a lot of institutions that want to buy these companies that are trading as close to MNAV, watch the valuation go up, use that stock market volatility to then sell more shares, to buy more crypto and stockpiling. So you see, Anthony Pompliano from ProCap just raised $1 billion to do this. So I think it's a sign of the times. How long will it last? That I think is the key question. Is this a forever trend? I'm not so sure about that, but I think for the next 2, 3, 4 years, you're going to see a lot more of it.
What about the strategy for a company like Strategy? We're seeing that stock pop today. They hold a heck of a lot of Bitcoin on their balance sheet. A little too risky, or do you
I think it's too risky because I don't know where their current MNAV's at right now, but they're, think of that like a PE ratio. You've got to be careful buying at too high of valuations. I don't get the whole premium. Why? I mean, at some point you think all these companies would kind of trade in parity with each other, where everyone figures out where that price is. But I'll give it to him. He is, Michael Saylor is a great promoter. Call it a visionary. I'll use a synonym, just like Elon Musk has been, and that translates into stock market valuations.
Yeah, and he's consistently defended that take, even on this show. So we're going to see how Bitcoin trades in the future. Thank you, Lou. And if you're interested in purchasing an electric vehicle, moving on here, saving some money along the way, well, you might need to pay attention to an upcoming deadline. Joining us now is Yahoo Finance's Praz Romanian, and still with me is Lou Bazanis. So Praz, we have this fast approaching deadline for potential EV buyers, and a lot of folks don't really know how quickly this is coming.
I mean, look, you need to act now if you want an EV, right? So Trump's budget bill sunsets that federal EV tax credit of $7,500 for new vehicles and $4,000 credit for used vehicles starting on September 30th. So literally basically a month and a half here. While smaller state incentives are still there, the federal credit was sort of the main impetus driving the sale of EVs in America. It first began in the Obama administration in 2008, and Biden expanded that during his term, right, to include both the new and used EVs. And In addition to the fact there's a point of sale situation where the actual credit actually gets deducted right when you buy, as opposed to waiting when you file your taxes. So it's just the best time to buy is right now. And if you want to buy, and then there's also the lease loophole, right? So lease loophole allows for you to lease any EV. It doesn't have to be American. Doesn't have to be under a certain price or a contingent upon your income level. You can lease any EV and get that $7,500 deducted from your lease payment. So look, it's the time to, if you want an EV, now's the time to get one.
All right, yeah, and like you're saying, you can save some money there. What are some of the tax credit eligible EV models on sale right now?
I mean, so for purchase, you're going to be looking at a lot of the American brands or cars that are made in America, which is beyond the Cadillac, Lyriq and cars like that, but also the Honda Prologue, which is made by GM in the U.S. That car also is available for the tax credit. It's a Ford F-150 Lightnings, and of course, how can we forget Tesla, Model Y, Model 3, Cybertruck? All those vehicles also made in America, and they are eligible for that loophole. And I'm sorry, for the tax credit. If you go to the Tesla website right now, they have a big banner that says, "Act now to get your Tesla before this goes away." So manufacturers are sort of talking about it. There's a bunch of inventory still available. I imagine by the end of September, it's going to be kind of dwindling. So now is your best time to get the best option in terms of availability.
All right, Praz, and you mentioned Tesla, and that's a stock that we're closely watching today. And we're seeing shares down about 0.8%. Lou, how do you look at a company like Tesla? Clearly a lot of volatility. We have seen, some pops here and there, but with the CEO like Elon Musk, it's just hard to know what the future of this company.
Yeah, I don't look at it in my portfolio because I don't own it, and I can't own it right now. I think back to the times remember when Jack Dorsey was running Square and Twitter at the same time, and we were very critical of that. Here you have Elon Musk that's not 2-timing, he's 4-timing, 5-timing as far as leadership in companies. I think what's key here is you're seeing the tax credits going away. If you look at the EV business right now, it can't justify Tesla's value where it's at. So it's basing its valuation on robotaxis and humanoid robots, which for me is a big dream, and it's too far out on the horizon. So, I think robotaxis are here sooner, but humanoid robots, I just don't see that making up the gap. And for me, it's a stock that I wouldn't own. It's in the Mag 7. It probably needs to come out in my mind. I've said this, Mag 7's a boy band that's broken up. There's different talent that you got to trade one by one, not as a group anymore.
Praz, I want to get your opinion on that, because it feels like Wall Street is very bullish on robots, bullish on, the robotaxi, autonomous driving. What have your sources been telling you about the future of Tesla?
If you look at notes from people like Adam Jonas at Morgan Stanley and Dan Ives, of course, friend of the show at Wedbush, they're both very big on not just robotaxis, but also robots. They call it embodied AI. It's basically injecting that AI into a physical object that can then kind of move around our world. I'm with Lou in the sense that I have a hard time understanding how we can see robots in factories by next year, is what Musk is saying. He wants to see robots being deployed in Tesla factories. That seems kind of like a stretch too far. But in 5 years' time, and we're seeing all the advancements in AI, maybe we might see more robots here and there. But I agree, it's sort of a sci-fi pipe dream at this point. But I'm not discounting it fully. But if you're an investor, you got to know your time horizon is at least 5 years, right? If you want to bet on that, that's what you're looking at. So it's not going to happen next year, but maybe 5 years, we'll see.
All right, we'll see. Praz, Lou, thank you so much. On the other side of this break, Levi CFO is joining us on the company's latest quarter. More when Market Catalyst returns. Levi stock climbing today. You're seeing shares up around 11% right now after the jeans maker raised its full year forecast and beat second quarter expectations, with revenue up 6% from a year ago. Joining me now is Harmeet Singh, Levi's Chief Financial and Growth Officer. Harmeet, strong quarter here, raising full year guidance despite an expected $25 to $30 million hit from tariffs. How do you plan to effectively mitigate that impact?
Sure, Allie. Thanks for having me. As you noted, we had a standout quarter. We beat top line, bottom line, and raised full year guidance. A special shout out to the teams around the world for what I call delivering the magic of the and, which is growing our top line and bottom line, growing direct to consumer and wholesale, men and women, tops and bottoms, and so we feel really good. We're had 3 consecutive quarters of high single-digit growth, beating expectations. So we are entering the second half with strong momentum. And this is the momentum, and we feel really good about the fact that strategies are working that enables us to manage through the uncertainty. Tariff situation is fluid. We took a position which is our guidance assumes an additional 30% on imports into the US from China and an additional 10% or tariffs on imports into the US from the rest of the world. And so our view is A, the momentum, B, the fact that we are competitively positioned. So as an example, 60% of our revenues are outside the US. Our sourcing base is very well diversified. And we believe, given the momentum, the teams can do a few things to kind of offset and mitigate this. So, we're working with our vendors to price the second half as well as the first half of next year. 2/3 of our growth is driven by higher volume, so that gives us a competitive advantage. We are also in the process of driving higher full price sales because our products are working. We're targeting some minimal pricing actions. And so a combination of all these factors, we believe, will allow us to mitigate the uncertainty.
Mm-hmm. And you were just saying how your guidance assumes 30% tariffs on China, 10% rest of the world. But as you noted, there's a lot of uncertainties here. If we do see higher tariffs, do you guys have a plan B to pivot and maybe be a little bit more agile to account for this unknown?
Yeah, great question. And the answer is yes. We are scenario planning. In fact, late last night after earnings, my team was already working on different scenarios given all the recent announcements. So we believe we have an agile supply chain base. We believe we have a team in action. A company that's been around for 170 years has seen a lot of things. And the agility that we have, the fact that we can chase products that are winning, the fact that we can diversify our sourcing base, I think are just examples of agility in action.
And Levi said it plans to absorb some of the tariff costs for now. What does that mean in practice? And at what point will you have to pass on costs to the consumers?
Yeah, that's the last thing we look at. The things are what can we absorb, through the relationships we have with vendors, through cost actions that we can take, through, the other fact of the matter is, with this pivot to our DTC first, which is our stores and e-commerce, we are in control of the assortments that we are offering to our consumers. And we are driving higher full price sales, fewer markdowns, because our product offers are working. And so we look at all that first before taking targeted pricing actions. And given the brand momentum and given the innovation that's coming, I see it. I know what's coming. I'm wearing the blue tab trucker jacket and the blue tab denim bottoms. The collaborations. Yesterday we launched a collaboration with Nike, and that is selling out. So I think there's enough brand heat and brand momentum, which ensures that our view is that the brand's never been stronger. The brand is in the center of culture. We have a partnership with Beyonce. We have other musicians around the world. And so I think, all that should help carry us through.
Yeah, I just went to the Beyonce concert. Levi's jeans stuck in my head during this entire segment. But when you look at the consumer, what sort of spending trends are you seeing? Are you seeing any trading down in any capacity? And it was interesting on your earnings call, you guys called out baggy jean shorts are making a comeback too.
Yes, they are. Really appreciate and thank the partnership with Beyonce. And so to your question about the consumer has generally been resilient, not only in the US but also in the world. We have different price points for different wallets. Our product categories. We have a tier 3 product that's offered between $40 to $50 in the US through our wholesale customers. We have a tier 2 and a tier 1 product that's offered at higher price points through our direct-to-consumer channel. And so the different price points for different consumers, depending on the wallet. The other piece that is of real focus is the product pipeline. You talked about baggier shorts. We have baggier straighter fits for men. The 502, which is a tapered fit, really works well. And we're doing all this while growing our slim and skinny jeans too. So, a very democratic brand. There's something for everybody. Also based on the wallet size.
And Hermit, you were talking about the different places you could go with your strategy in order to account for various tariff uncertainties. I'm curious, when you look at your outlook and you look at where the company's at, what do you think the biggest risk is? Consumers pulling back, or maybe more chaos within the trade realm?
I think uncertainty is not great for any business. Getting clarity is important. And that's why we said here is an assumption we are using to think of the business over the next 6 months or the next 12 months. I think that's more important, getting clarity, driving less uncertainty, both for the consumer, for our customers, that's the wholesale retail partners, as well as for our shareholders. And so that's the piece that we think about. And that's why scenario planning, different scenarios, and having game plans ready in the event of whichever scenario gets effective, I think is the best thing to do. We have a task force, a tariff task force that is working through this 24/7. And we have deep relationships with vendors. Our connection with our fans and our consumers is pretty evident that's working, because the other piece of it, Allie, is we cannot take anything for granted. We have to earn the respect of our consumers every day. And so driving, a consumer experience which is memorable. Hopefully your experience in buying the denim bottom for Beyonce was a memorable moment. For us, having those moments is important. There was a customer, I was in Europe, earlier in June, and Beyonce was in town. There was a consumer who wanted the Beyonce hat. She went to our store. Emily, our store manager in Regent Street, customized that hat. And it's a memorable moment for the consumer. And for us, having those memorable moments that tie into the brand are what make the brand better, make our products more relevant.
Memorable moment for the consumer and memorable moment for investors. We're seeing shares up over 11%. Hermit, thank you so much.
Thanks, Allie.
All your market action ahead. Stay tuned. You're watching Market Catalysts. Drone-related stocks are rallying on new reports. Defense Secretary Pete Hegseth has ordered a surge in drone production. That's according to Fox News. Names like Red Cat, AeroVironment, and Kratos Defense all seeing big gains on the news. So let's bring in someone who knows drones in the defense space well. Steve Simoni, he is the co-founder of Allie Control Systems. That's a defense technology company using AI-enabled systems to neutralize drone threats. The company is backed by David Sachs Craft Ventures. So what an interesting company in a very important time right now. I think about the Middle East tensions, the war in Ukraine. Give us a sense of how you're looking at the business right now.
I mean, it's undeniable that drones have changed the battlefield. The Secretary's memo yesterday is just another proof point of that. These drones are so cheap to make. You can put a little bomb on them. They're so fast and lethal, and they're taking out $1 million pieces of equipment on the battlefield right now. So we need to do something to counteract that, and that's why we created Allie Control Systems, which is we make a product called Bullfrog. It's an autonomous machine gun to try to shoot these out of the sky. Because if you think about it, if a drone's $1,000, a bullet's a couple dollars, and that's like kind of the way we think about. You have to change the battlefield economics.
Interesting. And we know Ukraine has struggled on the weapon front. Are your products being used in Ukraine, or how do you see that changing the game?
So yeah, every vehicle that's out there is vulnerable to drone strikes now. So like any sort of a tank, for example, or like a Bradley, or any sort of logistics convoy, everything needs what is called point defense against these new drones. So right now we're working with the military, the DoD, to integrate Bullfrog onto different vehicle platforms before we go into scaled production.
And when we look at the One Big Beautiful Bill, when we look at the Department of Government Efficiency, defense spending is obviously a big thing that investors have been focused on. Is that a concern to you at all if we cut back on our defense spending or escalate it?
Yeah, well, you see President Trump actually in the OBBB, they added $150 billion to the budget. And a lot of that is going to drone technology and counter drone technology. So we're seeing a lot of money come into this space from the top. And basically, it's a step in the right direction because we're really behind as a country on all this new technology.
So this is a catch up in a lot of ways, you think?
Yeah, we need to catch up. I mean, in China, they're making 1 drone per second. They make 90% of all the world's drones. We really don't do any of that here. And so part of the memo yesterday was to help bolster our industrial base and start making the stuff here. But it's going to take 5 to 10 years to even catch up.
Is China the biggest threat here?
Absolutely, 100%.
Interesting. And how is the AI boom also fast-tracked your business?
Well, so AI, it's actually AI and robotics, I would say. So there's been a lot of new technologies, like obviously the Nvidia Jetson card, for example, that goes into these new robotics solutions. And then there's also been a lot of innovation in the mechanical designs and the ability to move joints of robots. And you see that with the humanoid robots and stuff. So there's been a lot of innovation in robotics in the last 5 years, which we're riding that wave. So that makes it possible to put a bullet on a tiny drone at a couple hundred yards away, which is something that you couldn't do 10 years ago with the existing technology then.
And we were talking in the break about how rare earth stocks are surging and rare earth minerals are crucial in this technology. That's a key sticking point with our negotiations with China. So how important is it that we get a deal that allows us access to
this is a major national security concern. So China and Myanmar really mine most of the neodymium, which is the magnets that go in all the drones. Every drone has 4 brushless motors, every quadcopter, and those have magnets in them. And we only have 1 mine in our country. It's in California. And so we really need to ramp up production internal, in the US, but we also need to make deals and try to get some of that. But they're really tightly controlling it now because they know that's the main magnet.
Your company just raised a Series A. Do you have any plans to go public?
Not anytime soon.
I have to ask the question.
Not anytime. David would love that, I'm sure, someday. But not anytime soon. Right now, we're focused on getting the product to market.
Yeah, and Lou, I mean, as someone who's in the investment space, how do you look at what's happening with defense spending, all the efforts that are being made by this particular administration?
Yeah, I see it as a huge convergence that's enabling a lot of technology trends all at once, right? So you see drones, as you had mentioned here, this is also about AI, robotics. And as an investor, you want to look at what are the companies that are playing in all of those spaces that you can have exposure to it, because it's going to take time for this to ramp up. But I would say the defense spending, you're seeing not just in the US government, right? President Trump has struck a deal where now many other nations are going to be spending 5% of GDP on defense. So this is a global trend. It's a global threat, as you were pointing out. We start to think about, traditional warfare is outdated. It's more cyber warfare. But now you're pointing to the fact that drones are now becoming a real threat to all the military equipment, literally trillions of dollars of equipment that's out there on the field. So I love this. This is a fascinating use of a converging technology set to work in a national security setting.
Yeah, definitely an important moment. Critical time, too, with everything going on. But Steve, thank you so much for joining us. And Lou, thank you for joining us for the hour. It was great. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance ahead.